What do you know about the role played by compliance departments and compliance officers in helping your financial advisor make better wealth decisions? Specifically, have you ever thought about how the request you might make for an aggressive product or something that is not closely followed might be seen by corporate people who are watching the advisor to make sure that the advisor is making recommendations that are suitable for you? Let's talk about that. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. We had a fascinating conversation on Thursday with Fardan Ali, and Fardan is a compliance officer with Design Securities. What we talked about was something that most retail investors almost never think about, and that is the role advisors play as the ham in the sandwich who give advice to retail investors with regard to the suitability of products and portfolio construction and tax integration, but how they do that within the confines of a regulatory framework where their employer has to make sure that whatever recommendations are being made are done within the confines set out by regulators to make sure that the recommendations are in fact suitable for the client, both with regard to their risk tolerance and their risk capacity. One of the things that was talked about is offering memorandum products and how different firms, there are certain products that are offered by prospectus, say a mutual fund or an exchange traded fund, where the risk ratings are prescribed and they're the same for everyone. While there are other products that are offered only to accredited investors that are available through an offering memorandum, and how there is some latitude for firms to put what they would call a best practice, a company policy in place that will constrain the advisor's ability to make suitable recommendations for their clients. Here's an example. A lot of bank-owned firms, a lot of the larger firms will say that they are concerned about reputational risk. Now, whether that's true or not is open for debate, but the fact of the matter is that is their stated concern. And as a result of that stated concern, they will do two things that are really important with regard to how offering memorandum products are rated. Number one, they will rate virtually every single offering memorandum product as being a high-risk product because they will try to absolve themselves of any kind of responsibility if anything goes wrong because it's an offering memorandum product and they are more suitable for sophisticated investors. So number one, they just say everything is high risk, even if it isn't. And then number two, they will have company policies that will say, oh, and by the way, a typical investor cannot have more than, say, 10% of their portfolio in high risk products. Now, if you combine those two, if all offering memorandum products are high risk and the client can only have 10% of their portfolio invested in high risk products, that effectively means that any client cannot have more than 10% of their portfolio invested in offering memorandum products. Even though lots of other firms would say an offering memorandum product is, and this is obviously not true, we have to go case by case, but even if most people would say that the product is a medium risk product and it's not any riskier than a mutual fund or an exchange traded fund or any other kind of diversified basket you could buy, if the firm says it's a high risk product, the advisor is then obligated to recommend that product only within the confines of the risk profile of the client that he or she is giving advice to. So a lot of people who would normally have a risk appetite for more money going into alternative assets that are available through offering memorandum, are effectively given a ceiling of 10% where they cannot put more than 10% of their total portfolio into offering memorandum products because the firm has, in their wisdom, decided that those products are high risk and therefore you can't have more than that going into your portfolio. All of that is to say, a lot of investors are oblivious to these internal workings of how a firm's internal policies and personal and companies' views as to the risk profile of certain products, which might be self-serving, are to be dovetailed with regard to the advice that is given to retail clients. That plays out differently at different firms. And if the firm is particularly hard on the rating of OM products, offering memorandum products, to say that they are all risky, whether they in fact are or not, that will constrain your ability as an investor to use offering memorandum products. Now, that is not to say that offering memorandum products are good or bad, but what I will say is that there's certainly a number of people who could have more than 10% of their portfolio in offering memorandum products. It's not suitable for everyone, but it's almost certainly suitable for many people at a more than 10% allocation. You may not realize this, but your firm's compliance department may be constraining your ability to make better wealth decisions and to build more appropriate portfolios. This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.